Oh, I see one thing that says live. And do we see another thing that says live? Are we live yet?
I refuse to speak I'm speaking. I refuse to engage with you until I know we're live. I think we are. I see it.
We're
on YouTube.
I told you. I hit all the buttons right, Jeff.
You know, it's only been 21 of these, and you seem to have nailed it finally. So congratulations.
Isn't it incredible we've done 21 First Friday live streams?
Incredible is one word for it.
Yeah,
absolutely.
Yeah. All right. Hey, everybody. It is indeed time for our First Friday live stream. And as is often the case, it is not the first Friday of the month. It is the second Friday of the month. July 4th, Independence Day here in the U.S. precluded us coming on. Actually, it didn't preclude us. We just didn't want to do it on July 4th. Right, Jeff?
Yeah. Honestly, right. The bit of this being on the first Friday, except when it's not, is so fun to me that I kind of, even if we could do every first Friday, I would just want to throw a couple second Fridays in there just for fun.
At this point, yeah. I mean, it's branding at this point. It's not the promise of actually being here on Fridays. I see a couple folks have joined us coming in. Don't forget, we've got the chat over in YouTube. Throw in your chat. We will engage. We will answer questions. We do have some planned topics today as well. One of the things that we need to do, we're not going to do this first off, but we typically on the first Friday show, that's when we cover the latest updates for the Investing Unscripted 2025 investing portfolio contest. So we owe our viewers and listeners an update, not just for the month of June, but June was the end of the second quarter, the end of the first half. So we've got the quarterly winner.
Yes.
And we'll talk about the standings halfway through the year.
Yeah, we'll talk about this. We'll talk about the quarterly winner. We'll maybe share any thoughts we have on how that contest is going. I certainly have some as the person who has to manage that Google sheet with all the results. But yes, it is time for the Q2 review. We will reveal the winner and talk about that winner's charity so that everyone who listens to this podcast, all dozens of you, can open up the checkbooks and give some money to a worthy charity, which is really the reason we do it. That's the fun part about the fun part is talking about the stocks, but the good part is contributing to some charities along the way. So we'll do that maybe halfway through the show. Once we get rolling here, we have some more people online with us.
We've got Teo. Good to see Teo with us. Couple stocks that are rocketing. We'll talk about SoFi and QuantumScape both. John Denley says, nice to be here. John's nice to be here. John is a member of our starter position. He's gotten pretty active in our Discord group, so that's been a lot of fun. Ali hopping in the chat here too. Good to see you. Jesse Merritt, another member of the starter position. I don't want to pump that too much, but I'm going to right now. I'm talking about it. These are the people that give us $5 a month through our Patreon membership. And for that $5 a month, you get access to our exclusive Discord server. It's a small group. Like, we want to kind of keep it a small group. But also you get access to the limited ads episodes of the podcast that you can listen to on the Patreon platform, and the exclusive rough cuts that we do at least one a month. So that's
at least,
that.
And it's at least one. I'm going to say this.
At least. I want to do more. I do too.
We do have a nice little queue of topics that we're going to rant about. So we're keeping them. So we have at least one a month, but when our summer schedules align a little bit better, we will absolutely have months where we do more than one, because those are fun. We have fun doing all this stuff, but I think the rough cuts are particularly fun. We can be a little looser, a little more conversational, and we're pretty loose and conversational regardless. So
right. Exactly.
So why don't we start, Jason, with these rocket ship stocks that Teo brought to the table here. We can talk about SoFi. I know that's one. So interestingly, I have a friend who I know through my day job, and he reached out to me. I hadn't talked to him in a while, and said, hey, remember when we were talking about SoFi a couple years ago? Because he held on to his shares. I think we were talking about it, like 2023-ish. And so I sent him a picture of the stock chart from 23 to present day, and he was pretty excited about the returns he's seen there. So we can talk about SoFi. QuantumScape is a company that you and I talk about a lot. I'm interested in this space, not as much in any individual stock, but as an EV driver, the idea that we could be closer to having solid state batteries is enormously exciting for me, even if it will likely drop the resale value of my car significantly. So Where do you want to go? You want to go SoFi? You want to go QuantumScape?
Well, let's start with SoFi because I actually made a decision. I was looking today, not today. I'm sorry. I was looking earlier this week through my portfolio, and so I manage all of my personal invested wealth, joint account with my wife, taxable account, and some rollover accounts of my wife retirement accounts. And it's all invested in individual stocks and some bond ETFs and cash. And I almost sold in one of my wife's accounts half of the SoFi because it has gone, I don't want to say ballistic, but it has really rocketed up over the past month or so. And what I've actually decided to do instead is just sell cover calls at a big premium to the current price. Because as the stock has gotten more rocket shippy, the volatility's gone up and that beta goes up and the premiums get better. And of course, I'm taking the risk of the stock being called away, but I sold some January calls at the beginning of the week. That's still like $7 or $8 a share more than the current price. So I mean, the stock would have to go up another 15, 16% for the shares to be called away, and so I would earn the premium that I got. And the stock's going to come back down. It's like, I know it's at some point. I don't believe that this is the floor for SoFi stock because it's moving on momentum at this point. We're getting into bank earnings, so it'll be interesting to hear what we start hearing from some banks over the next week or so.
So I have not looked at this stock at all. You know how I feel about banks.
Yeah.
What's been driving this? I mean, is there anything, or is it just one of those stocks that has gotten everyone's attention and therefore that in and of itself is driving the price?
So SoFi's gotten involved in a couple of things, like a big one earlier this week, and I think this is the one that's really driving the momentum this week, is private markets. So pre-IPO companies, like the ability to invest in, just to throw popular names out there, like SpaceX or other companies out there, that there's lots of, VC funders, but also you have employees and former employees that part of their compensation is equity. And these groups work deals with those parties to get options or access to be able to buy their stakes. And then they bundle this stuff together for retail investors. So the market is excited that this is one of the things that SoFi is going to be bringing to retail investors. And I'm a little of two minds about this. On one hand, it feels like another case of the big money repackaging something in bags that they can sell to retail. We've seen talk about it with private credit. When we went through the SPAC boom in 2020 and 2021, retail is who got screwed, right? Retail got the bag, and all of the sponsors and they were fine. They're completely fine. Came out a lot of that stuff fine. But so I do have some concern about that. But I mean, one of the things that we've talked about, we had, Seaplane Ventures. I'm completely drawing a blank. Former fool that we had on.
John Magyar.
Joe Magyar.
Magyar.
Thank you. Yeah, Joe. We had Joe on. Joe, I apologize for blanking on your name. So Joe and I, one of the things that we talked about when Joe was on the show was we've seen, Amazon, like when Amazon went public, it raised a few $100 million. Fast forward to when Facebook went public, it raised like $10 billion. And we're seeing companies today that are going public raising 20, 30, 40 billion. And they're much older, more mature businesses that are going, when companies are going public, like the institutionalization of venture capital has created this environment where companies stay private in the quote unquote startup phase longer. So the other part of my mind is that it's worried. It's like, okay, the smart money is just looking for retail to be bag holders again, is also acknowledging that creating access for retail to get to take on risk and invest in these companies earlier in their growth phase, it is compelling. It is compelling. We'll see, when the Wild West clears, we'll see what it looks like and whether it's really compelling or just another case of retail getting screwed. But the market likes it for SoFi right now, so it's doing good for me.
Yeah, I mean, look, I'm happy for all the SoFi shareholders who apparently are all in our chat right now. I don't know. I could never, and you've been talking to me about this stock for years, and I just cannot get myself excited enough to even think about investing in it, partially because I'm just not a fan of bank stocks, but also I just feel like at some point it will just become a bank stock. Yeah. And maybe I'm missing it, but that's my vibe.
It did back in April, but it's not a bank stock anymore.
Yeah, it's the rocket ship emoji stock. All right. So
I think just one follow-up to that I think is important is I think when it comes to the bank things, if you look at their balance sheet, if you look at their operating statement and you look at their segments, the slowest, not the slowest, one of the 3 slowest growing parts of its business is its loan book. And that really reassures me because my biggest fear when SoFi bought Pacific West Bank, whatever it's called, Golden Pacific West Bank, when it acquired the bank to get the bank charter, was that they were going to forget how to be responsible about underwriting risk. And you want to grow quickly, you just lower your threshold for risk, right? You lower your lending standards. They haven't done that. Their loan growth the rates have been relatively steady. They've actually slowed a little, while the acceleration we've seen have been in other parts of the business. And that kind of reassures me. It really does. And at the same time, they're doing more like their mortgage business has actually started to grow a little bit. And that's a safer part of lending that they haven't really been in. So those are things that have reassured me about it. But yeah, despite John Gallegos saying the stock's going to go to 30 by the end of the year, it might go to 30. I don't think it'll stay there. It's going to be super volatile.
Well, and this is, so I'm going to pick on some of our viewers here who have referred to SoFi as a technology stock. I don't know. What am I missing? To me, it's a bank stock that uses technology.
So where it's their Galileo platform that they acquired, that's a big part of the business, is really important because it's the payments platform that a lot of other fintechs use for payments processing that don't have the scale, or it wouldn't be a smart allocation of resources for them to build their own payments processing.
So in that
that's
sense,
a good
they're a tech
business
company
that they have, and it is growing at a pretty good rate. So that's a fintech part of their business. Almost everything else, though, is just banking and financial services that are often offered by bank repackaged. It really, really is.
All right, we got some comments here. Let's hit these quickly, and then we can talk about QuantumScape. Colin has a good one here. My man Jason, I like the locks. You no longer look like that you don't cut your lawn or that you make a weekly trip to the local gas station to buy a log of mint skull to chew in your rusting T-Bird. Colin.
I was always a Golden Blend guy. I just want to tell you that. I was a Golden Blend guy.
John Gallegos, who will never come online in any capacity while I'm on the air and not bust my chops about Outside Medical, pointed out that it was down 6% today.
Yeah.
Thanks, John. Saw that myself.
Yeah.
All right. Here's one from Ken. Someone in an investing community referred to his investing mentors as the Motley Fool coaching tree. If David Gardner is Bill Walsh and you guys come from the tree, who are your NFL equivalents?
Oh, that's interesting. So David Gardner is Bill Walsh. Who do we extend from Bill Walsh? Who's Bill Walsh's coaching tree? That's a tough one for me.
Oh, I'm definitely, I don't know, like a water boy, maybe, like a statistician. I'm like the guy with the clipboard who you see get run over by a wide receiver who goes out of bounds or something. That's me.
Yeah.
I'm the guy leading the marching band who plays at halftime.
So the funny thing is, like, building the coaching tree from the Motley Fool, though, and bringing those people in, and not trying to find my, no, you're right. Ken Taylor says literally everyone. That's kind of true. It's funny. I think I have become a little bit more of a defensive minded investor. I've talked a lot about that as my strategies have changed. As much as I've so much of my portfolio is still built for capital appreciation, I've gotten to that point where there's a little bit of capital preservation thing going on too. So who came up with the cover 2 defense? Who was that?
I don't know.
Who is that? Maybe that's me. Maybe that's
right.
me.
I like it.
Who's the coach that's been fired the most? That's probably Jeff, is what I'm thinking.
Yeah. Who's had the most jobs with the most teams for the least amount of time? That would be probably some Jets coach. That'd be my guess.
Yeah.
All right. Last one from the comments. Then we can talk QuantumScape. Ken also says, is Jason trying to get a tech job or a Netflix role as the dad next door? I'm going to go with dad next door. He's literally wearing a men's middle-aged softball jersey as we speak. So he is ready.
These are custom, by the way. These are custom designed.
He's ready for dad life. He's a dad life aficionado here.
Funny thing about the glasses, these are readers that I have to wear when I have my contacts in because I can't read. Oh, Jeff, actually, you look a lot better with these off.
Yeah, well played. Well played.
There you go. Okay.
I don't even have your camera on my screen. That's how I get through these.
I wouldn't either if I was you. It makes
All
sense.
right, let's talk QuantumScape, Jason.
Okay.
We did a QuantumScape video on our YouTube channel about a week or two ago, right after it popped, I don't know, 20, 30% on the news that they had hit a milestone sooner than was expected. And we did a good 10, 15-minute chat about that. But we haven't had that conversation here with our live audience. So let's do it. I said earlier, I've been interested in this stock for a long time. I just have not pulled the trigger on buying shares. So I'm a little bit more interested in the technology than the stock. I guess I don't have enough knowledge of the industry or sense of the competition to be able to determine if they will be a winner, the winner, or if one of the bigger, more deep-pocketed companies might get there first. Like, I know this is something that Toyota has been working on. I've brought that up to you several times. You seem to think that that's not as much of a threat as maybe I do.
Yeah.
So quickly, which
all right.
means
So yeah,
5
for
or 6
anybody that
minutes,
wants like the longer version, go to our YouTube channel. There's the video.
Yeah,
It's
let's not
pretty
do the
recent.
whole thing.
Yeah. So I think it's probably a close to 10-minute conversation, but the short version is on the 24th of June. So it's 3 weeks ago now, roughly 2.5 weeks ago, that they announced that they were bringing their separator process. They were integrating it into their baseline production. What does that mean? Their initial separator process, they called it Raptor. And so the separator, it's the thing that goes in between the cathode and the anode. It's the best way to think about it.
Does it separate those two things, Jason?
No,
Oh,
it
okay.
integrates them. But the key is that it replaces like the liquid in lithium ion and liquid state and gel state batteries. So it's the solid part of solid state battery, right? So the trick is manufacturing these things. We're talking like semiconductor industry levels of precision that you need to do that. And these are for cars. They're relatively large, and you need hundreds and hundreds of thousands of them, right, to meet the anticipated hopeful demand. And the short version is that their Cobra, which is the newer process, is substantially faster. The equipment is smaller, and it's more consistent. And they've integrated that into their production now, which is great. They're still pre-commercial, but they're manufacturing sample cells that are actually the cells that will be commercial. So they when they reported earnings, 6 weeks or so ago, they said, maybe 2 months ago, they said they would have it in before the end of the first half, and they did. So they met the goals, which they've done a really good job of over the past 2 or 3 years. So I don't think the market expected that. I think the market was expecting delays and problems and issues. And it really caught the bears off guard, I believe. And we've seen the stock go through a little bit of I think it was largely a short squeeze, where the stock more than doubled. I mean, it was in the 4s when they announced that, and it maybe hit $9, over $9 a share here recently. So it's a big validation that what they're doing is positive and working. And then if you look at essentially all of their executive hires from the CEO all the way through operations. They're bringing in people that have commercial manufacturing, precision manufacturing experience, a lot from the semiconductor industry. So they're ramping up and getting ready for commercial manufacturing next year.
All right. I have two questions.
Okay.
Question one, what do you think about it right now as a stock idea for someone who's someone, who might be someone who co-hosts the podcast with you and has been thinking about buying shares, but is not? Where does today's valuation price sit compared to what you think is fair? I mean, this is still a pre-revenue company that has not commercialized a product yet. That's my first question. My second question is, when will I be able to buy a car with a solid state battery in it for my next vehicle?
So I'll take the second part of it first, because I think that's important to getting a line of sight into the potential value of this business. I believe that there will be cars with solid state, QuantumScape solid state batteries manufactured within the next 18 months. So second half of next year, I believe they will produce cars. I don't think you'll be able to buy those cars because they're going to be like Maseratis and like high-end Lambo,
I won't be able to buy more than one, is what you're saying.
Right. And you'd have to use your wife's money to do it. I would too. So, but no, my point is that I think that's what they're going to go after first, because that's the Tesla model. That's where you can get margin and people will pay a premium. Right.
And then over time, the cost will come down and blah, blah, blah.
Yeah. But that's also where the technology is most optimized, because you can get super fast draw of power, that current you need. You can charge it fast. They're lighter. Like all of the things that solid state solves for that are problems with the current state of technology, that's like the most optimal place for them. But then exactly what you said, you prove it out, you sell them, then you start scaling up. So remember, Volkswagen's the first partner, the joint venture. They're the ones that are mostly going to be building the capital for the factory. They're going to want to see some return pretty quickly. And my guess is they're going to go upscale. Maybe they're highest in Audis, things like that, is where they're going to go. But I think 2027 at some point, maybe second quarter or later, you'll be able to buy like their mid-level electric vehicle with solid state batteries. I think it's going to happen that quickly within 2 years. We're going to.
What are the chances you think they just get acquired eventually? Like once they prove this can work and can be commercialized and is in cars, why would a deeper pocketed car manufacturer or even just a bigger manufacturer general sweep them up?
Because if it proves out, why would you want to be acquired? I think that's the key right there. If the technology gets proven out really quickly, that it can be manufactured at scale, there are enough early investors that have large enough stakes to prevent that from happening, right? Unless they run into some sort of a capital crunch. But again, if you demonstrate the technology is viable and you can manufacture it, there's going to be investors that are willing to lend you capital or do secondaries or that kind of thing, convertible debt, that kind of thing. So I think if it's somewhere in between a success and a failure, there's obviously viability and the IP has potential. Maybe Volkswagen buys it. But you've still got a couple founders involved in the business, including the chief technology officer who has a pretty big stake, a board member, JB Strabel's on the board. He has not a giant stake, but a meaningful stake. So there's enough stakeholders like that are involved that want to see this succeed on its own, where instead of your Volkswagen's battery provider, their internal, you're supplying to the market. I think that's the path they want to go down. You mentioned competitors. Toyota hasn't shown anybody anything like in the real world, right? They've talked about it. With QuantumScape, we know that there's multiple OEMs, probably a half a dozen OEMs that have tested the product in their environments.
let me play the devil's advocate thing on Toyota, and I'm going to give Tyler Crow credit for this because he's the first one who said it to me, which made me, but it seems viable to me, right? So one of the curious things about EVs over the past, let's say 7, 8, 9 years is that pretty much every car manufacturer, even Honda finally, even though it took them a long time, has put efforts into electric vehicles with the notable exception of one, and that is Toyota. And they purposely and publicly put all of their eggs in the hybrid basket. Now, there is one side of that reasoning, which is that's the bread and butter. The Prius is 25 years old. It has proved to be a ridiculously reliable, great car, if not no fun to drive. And so my original thought was, well, that's just their expertise. That's what they want to do. It's probably where the market's going to be for a long time until infrastructure builds out and until battery technology gets better. I mean, I'm an EV driver and I don't take the car everywhere because of range issues and not wanting to stop and charge for a half an hour or 45 minutes. But Tyler said to me once on a live stream, he wondered if the real reason Toyota was not diving into EVs was because they're slow playing this until they can get solid state battery technology done. And then that will be when they go whole hog into electric vehicles. And that actually makes a lot of sense to me. Keep it close to your vest, sell hybrids like crazy, because that's what you do. And then get the technology that no one else has. And just all of a sudden, now you're putting out electric vehicles with the best battery technology. Thoughts?
Maybe, but again, there's this massive dearth of evidence that they've actually done it. And this is the same company that's been trying to do something with hydrogen in cars for longer than they've been making EVs or hybrids, and there's just been limited commercial success there. So I'll believe it when I see it. And I'll say this though, I don't think this is a market where there has to be one winner, especially if you've got IP, because if Toyota has great battery tech, they're going to monetize it. They're not going to necessarily be, so, I mean, we'll see joint ventures. You always do, like the Subaru EV, is a Toyota, right?
Yeah.
And the Toyota EV is the same car. So you always see
the Honda Prelude is a GMC Acadia, I think. They have a joint venture too.
So you'll see those sorts of things happening, but I don't think that precludes, us seeing, a QuantumScape be successful, even if Toyota does figure out the formula. QuantumScape has some good things positioned in terms of materials that could be really impressive from a cost perspective. So we'll see how that plays out. But I do think QuantumScape's in a good position. So to answer your question, is this an investable idea? The market cap's about $5 billion. So
it's bigger than I thought.
What's that?
Bigger than I thought it would be.
Well, it was, $2 billion 6 weeks ago, right?
Fair.
It's so what's going to happen? It's still pre-commercial, right? There's so many things that can happen between now and making batteries that could send the price up or down. I think it's definitely going to be volatile. I wouldn't be afraid to pay this price today. If I knew everything that I know about the company and never bought shares, I wouldn't be afraid to open a position at this price. It wouldn't be a big position. It'd be a starter position. Because I do think if it's successful, this can be a $30 or $40 billion business. And over time, potentially a good bit bigger. If you're a primary battery supplier for, the vehicle industry, and then iterating from there into other industries where you don't have the same volume opportunities, but you can get better margins on smaller batteries. I think it could be compelling in a lot of ways.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free, And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, Colin's got a question for me, and it's not insulting me at all, which is interesting coming from Colin. But I got one for you,
do
Jeff.
better.
Yeah, seriously. You often seem to think deeply about your individual stocks. Why don't you just move on with your life, index, and still be rich in the end? Do you enjoy the excitement of it? So I think my answer to that, Colin, is I'm kind of doing both. Most of my invested wealth is in index funds. So I can afford to enjoy the excitement of it. In what is 15% of my invested money is in individual stocks. Like I can have some fun there. I've said before, like if my entire stock portfolio went to zero, that would really suck, but I would still be able to retire. Like I don't think it would absolutely crush me, and I don't expect the entire portfolio to go to zero. It's not nearly that volatile that I think that's a possibility. The way I look at it is like this. I'm going to end up investing on the mutual funds and index funds and ETFs that are in all the accounts held between my wife and myself. That's what's going to get us to retirement. I look at the stock portion of my portfolio as a few things. Extraordinarily educational for me, something I super enjoy. I like the act of researching stocks and talking about them and thinking about it. The amount of time I spend thinking about that 15% of my portfolio is absurd. But it's almost like an options contract in my brain. Like if I've talked before about dumbassing myself into an NVDA investment that's up 700 something percent right now. If that had happened a year later, if I had bought those shares a year later, not actually a year later by the calendar, but a year further into my investing journey, or maybe 2 or 3 years where I was buying bigger chunks of things and not taking these tiny, tiny little bits, that would be a significant amount of money in my portfolio, right? If that had been what I consider now to be a pretty good sized position and then gone up 700%, but I'm not banking on that. I'm not thinking to myself, fingers crossed, I get something that is an 8-bagger so that my kids can go to college, or I need something to 10x so that I can retire. Like that's not where I'm at. So I am indexing myself into being rich, to use the way you framed it, Colin. I enjoy the stock part, and I feel like if I do good / get lucky and hit it big on something that's in that stock portfolio, it's icing on my retirement cake, right? If I have it in my brokerage account, maybe I use it to pay off the last year of my kids' college, or do a nice vacation when I retire, or who knows, right? Whatever I want. And if it's in my retirement account, it's just more money for retirement. So, but I do think about when I am frustrated with my stocks and not feeling good about it, I do think to myself, why don't I just sell all this and put it in an S&P 500 index fund? So I get it.
I have 3 comments here. So first of all, I think you're training for when you retire and you roll your 403B into a rollover and you invest all of that in individual stocks that you have high conviction in. So number one, I think that's what you're doing right now.
I don't know if can you do that? I don't think you can do that once you retire.
Of course you can. Yeah,
I thought you could only. All right.
Yeah, no, of course you can. It's yours. You do it. You move it wherever you want to. So you just roll it over into a rollover IRA.
Okay.
So I think that's what you're doing.
I'm going to put it all in QuantumScape.
So now we're talking. I like this one, John Gallegos. I said which coaches like moved around a lot, and he says John Gruden. I like that. Here's the thing: Gruden won a Super Bowl, but he won the Super Bowl because of what the coach that he replaced, Tony Dungy, had built. So, what's your best performing stock?
Me?
Yeah,
Best performing? NVIDIA.
NVIDIA, that you bought because somebody else told you it was a good stock, right?
Basically, yeah.
Okay. All
I
right.
kept it because of my own conviction, but I bought it because of that.
But that's your Tony Dungy Super Bowl, right? That's
Fair.
yours. Okay. All right. So that's that. Now the last thing, Colin follows up here, says, it's time to move on, Jeff. Index, your family loves you. Go to them. So yes, his family does love him, but they want him to keep looking at the stocks. They really do.
I was going to make the joke that I'm not so sure they love me or want me to go to them.
They love you. They just don't want you around.
Yeah. No, I think they're pretty happy if I'm just up here in the office, researching QuantumScape and watching my outside medical position go lower and lower.
Yeah, John Denley, agree with Jason. That is my plan to learn now. So John, I think that's a great approach. Lewis Brooks, also active in our Discord. I can't wait to roll over my 403B into individual stocks. So see, there's a plan.
I never even thought about doing that, to be honest with you. We'll see. We'll see where I land when I get to that magical age. We'll see what my financial life looks like. A lot can happen between now and there. I mean, we could see an epic, great financial crisis like crash, and I could be in a totally different spot. We'll see. We'll see how it shakes out.
I mean, if that happens, it's a perfect time to roll out of those
to roll
funds.
over and buy stocks. Yeah, I know.
Yeah, it's perfect time. So, all right, I think it is time for us to do a review of the contest. But before we do, Jeff, I just want to make a call out. Looks like we got a couple dozen people on. Hit the like button for us if you could. What that does is that it helps promote it on YouTube, and maybe some other folks that haven't seen us before might find it, and then they'll watch the boring part of the live stream and we'll never see them again. But let's give it a try, folks. If you don't mind hitting that like button, that'd be awesome. All right, you ready to talk through the contest?
All right. Yes. So there's a disclaimer I'm going to put here at the beginning of this. Anyone who's listening who has a portfolio in our contest, it is your responsibility to check my work, because I think I've said this before. I will say it again. I will say it throughout the rest of this year. This was a huge mistake, trying to manage this many stocks where we're counting dividends and people are allowed to make changes has been a much, much, much bigger project than I anticipated when we came up with this idea. So it is very possible that something is calculated wrong, either because I fat fingered it or because the other weird thing is sometimes Google Finance will pull the wrong ticker even after it's been pulling the right ticker for a while. I'll give you an example.
It's so buggy.
My wife has an ETF that the ticker is NOBL, which is like the Dividend Aristocrat ETF, I believe. Mm-hmm. And randomly about a month ago, Google Finance started to pull that as a completely different stock, because I guess there's an ETF that has NOBL as its ticker and there's a stock that has NOBL. It doesn't know which one I'm asking for. So check your own portfolios, do your own math. The cash amount that you see on your portfolios should match whatever cash was in the account when we started the contest, plus any dividends. That's all done by calculations and formulas and stuff. So anyway, there could be glitches. So with that out of the way, I am pleased to announce that the winner for Q2 is John Dargan, who is a member of our Discord. And he had a return of 53% just in the second quarter.
Yeah. So again, that's April 1 through the end of June.
Right. Yeah. Now, here's what's interesting, Jason. In Q1, John Denley was our winner at 11%. He was only one of 4 people above water in the green, and the S&P 500 was down 5% in Q1. In this quarter, if the S&P 500 was a team competing against us, it would have come in 4th to last. The S&P 500 did 11% in the quarter, and everyone except 4 people, you included, did beat the S&P 500 in Q2. So what that tells me, Jason, is we have some people who love growth stocks.
Yeah.
Because it
loves
I know this,
volatility.
The volatile stocks tend to outperform the S&P 500 when the market is doing well, and they tend to underperform when the market is doing poorly. So we will see how this shakes out over the course of the year. Anyone who's interested in seeing this, whether you're in the contest or not, the link for this and the last 2 years portfolio contest is always in the show notes of any podcast episode or YouTube video. And there's a tab called Winners, and it's currently sorted by the Q2 winners, so you can check that out. Now, John maybe didn't win because I could have totally screwed something up here. So all of this is with a caveat and grain of salt, but that's who I think is the winner. And if I believe I can pull up John's charity, which is, give me 1 second.
Lifehouse
Duluth, and
yeah,
the link
is
to that.
the link. If you click on the tab for audience members, and then just search for John, it'll pop up. You can click on that link. I'm going to read the description. Lifehouse provides comprehensive supportive services to meet the needs of our youth and youth families ages 12 to 24 who are unstably housed and or navigating various challenges in life. I want to say one thing, and this is going to sound political, but I want to say this. One of the things that was part of the big, beautiful bill that was signed into law strips out access to food stamps for youth that are aging out of the foster system. I won't even say what I think about the people that agreed to allow that to happen, but Lifehouse is the kind of organization that's helping bridge the gap for those kids that happen to be now adults that have already been given a terrible hand in life, and the system has now turned its back on them. So I'm gonna donate $200 to Lifehouse tonight, after my softball game. I want to encourage everybody else here to do a matching contribution of some sort.
Yeah, I agree. That's how the game is played. Whoever wins the quarter, we all give money to that charity. And by the way, even if I did screw something up and John didn't win, we should all give money to that charity anyway. By the way, I misspoke before. John Dargan is not in our Discord. It's John Denley that's in our Discord. I got the wrong John D.
John Dargan, step up. I'm giving money to your charity. Did the $5 a month.
But yeah, I mean, so just looking at the whole contest, big picture, Jason, that was my kind of reflection, having gone through all of these and looking at who the winners were. In a quarter where the market gave us a year's worth of returns in 3 months, everyone crushed it. Everyone meaning everyone except a few people, including you.
Well, yeah, because I've really sucked this year. I don't have much more to add than that. So it hasn't been good. Apparently I'm not a very good investor.
All right. I'm glad you said it so I didn't have to. Let's talk about, I don't know. Part of me feels like I don't want to talk about this, but I think we should talk about it. Tariffs. Because we are back into, I guess now it's tariff time. Like it was tariff time and then it wasn't. And then it was war time. And then it was big, beautiful bill time. And now it's back to tariffs time.
It is. It's tariff time again.
And
okay. All right. I did it. I couldn't wait. I've given the $200. I've done it.
Okay.
All right. Let's talk about tariffs.
You always do things like while we're on, like recording something together. It's bizarre.
Hey, raccoon on meth. Sometimes he comes out and grabs my credit card. What can I do? All right. Let's talk about tacos here, right?
My take is that the market is not paying attention to this anymore. Tell me I'm wrong.
You're not wrong.
All right, let's move on.
No, maybe a little. I mean, the market fell today. European markets fell. I didn't see where the market closed. I know it was down at 12 or 1 o'clock. Last time I looked at it, it was down. But all the European markets fell because of this latest saber rattling, particularly the ones with Canada. And you're hearing different things out of the EU than you are out of the White House in terms of negotiations there. The blanket 10% percentage point tariffs on a lot of other trading partners. Yeah, I think maybe we're starting to see some cracks based on the market sell-off today. Seeing a sell-off on a Friday after the market's been as good as it has been. So I say that, but then I was talking to Lou Whiteman. We were talking about airline stocks. Delta reported earnings and like raised it, like had a great quarter, raised their guidance across the board for the full year. Like every major airline stock was up double digits when the day yesterday when that happened. So obviously there's still a lot of money on the sidelines pent up that wants the market to keep going up and wants to buy stocks that are going to go up. So I think largely you're right, but maybe not.
Yeah, I'm not saying it's never going to react. I'm saying it seemed like in April, right? Now we had like the initial shock of Liberation Day, and the market obviously took that very poorly, right? We had those 2 consecutive down 5% days, and we touched bear market territory ever so briefly mid-April, and then everything kind of turned around. But it seems like after the ensuing 3 months of on, off, taco, whatever you want to call it, it just feels like the reaction by the market is more and more muted every time. And even the supposed 90-day deadline, which was supposed to be this week, the 9th, Trump came out and was like, oh, actually, it's August 1st. We're going to put all these into effect. So really, the deadline is now August 1st. And I would not be surprised if August 1st rolls around and it becomes September 1st. So I'm not saying we're not going to see moves. I'm not saying there's not going to be down 1% days, up 1% days on news. But like, I don't know if we're going to see a really big reaction until there's an actual, like I've been saying, until we start offloading ships from China at 135% tariff or something, like, or there's empty shelves, or we actually start to see low inventories of things, like actual tangible, no, this has already happened, it can't be undone. That's when I think we'll see an impact. And I'm still in the camp of we're going to see a bad second half of the year. I just don't know if it's going to happen based on the whims of what gets posted on Truth Social at 3 a.m. by the president.
Well, there are real tariffs in place on, steel and lumber import. Like there are meaningful tariffs in place that are definitely affecting key inputs to things that we're buying. And it's already having an impact on certain sectors. There's no doubt about it. LDP says it's just simple math. The U.S. needs money to downscale its debt. Don't want to use the word tax increase, so here comes the word tariffs. To some extent, yeah, I think that's right, but it's still the math doesn't math. You can't, especially with this latest spending bill that flipped the size of the deficit even more. You can't tariff your way out of that. There's just, it's not going to happen, right? Even if it structurally changes things where there's more domestic manufacturing and you grow domestic productivity.
And by the way, we pay the tariffs ultimately. So it's just, we're just
American consumers. Right.
So we're paying down the debt.
Right. Sure. Maybe a small fraction of them will be pricing reductions from the producers overseas, from the exporters, but it's still going to be paid by the end consumer at the end of the day. That's
I know I just said I think we're going to see a rough second half of the year, and there actually could be an economic impact to all this. But there is the other side of that in my brain, which is the rich guy theory. This is my theory of life, where ultimately the reason we won't see anything terrible is because the rich people won't allow it to happen. And we saw that a little bit when the Liberation Day tariffs got rolled back a few days later. There is part of me that feels like at some point the super rich people are going to go to the super rich people and say, enough, hit the gas pedal, or hit the brake. I mean, we gotta slow this down. It's a sad state of affairs that that's what saves us, but part of me thinks that's what's going to save us.
Right.
At least up to the point where that can be the thing that saves us. So we'll see. All right. I don't want to have a whole long conversation about tariffs, but it's been in the news this week. I thought we should hit it a little bit. So Jason, I already said, I'm on the record saying I think we're going to see a drawdown, a downturn, an economic slowing, however you want to frame it, in the second half of the year. What say you? What's your prediction for, now that we're into Q3 by 10 days, what is your Q3, Q4 economic forecast that we will obviously hold you to see if it comes true?
Maybe. I think we might.
Way to take a stand.
I think the thing that supports it is that we know that a lot fewer things have come into the US, right? And that could affect consumption just because there's less stuff on shelves to buy. So I think it may happen. I don't have a strong position on this. I'm so uncertain about it. I really am uncertain. But what have I been doing? I decided to trim a few positions and trim a few weeds in my portfolio today. So I've freed up some more cash. And I may rebalance a little bit sometime in the next week. I've thought about it. I may restart some options. I may buy back some puts early. I've got some puts that are a little bit profitable. I may buy them back early to free up the cash that's reserved if the shares do get put to me. So I'm thinking about doing some things like that to be a little bit more defensive. I also know that I don't need to. And if every single put that I've sold, the stocks got put to me at the price that I agreed to, I'd be fine with it. So I may not do anything in that regards, but I have started doing a little bit of the housekeeping in my portfolio, or try to do a few times a year, while the market is definitely very richly valued.
Yeah, I did the same. I mean, we talked about it on the last podcast, right? I sold a couple things at that tiny positions that were in that fund portfolio we did with that money with my dad, the Knicks picks. Sold a couple of those. I sold all my crypto except my Bitcoin. That's something I haven't talked about on the podcast yet. I think I mentioned it in our Discord. Crypto's just feeling really gross to me right now. Like there's so much, there's so much grift with it at the moment. I mean, maybe always, but it just seems in my face that, I don't know. It's one of those.
We thought a lot of that had kind of, with the stuff that happened with, back during the crypto winter, when there was, clear fraud and people went to jail, it felt like there was some cleaning of house that had happened, but here we are.
For me, this was a complete gut / invest in the future you want to see move. Part of the logical lizard make money brain in me said, this is absolutely the time to hold on to crypto, because the grift and the crime and the fraud will probably drive all of the prices I sold at higher until it doesn't. But I just did not want anything to do with it anymore. And I'm not sure I'm going to keep my Bitcoin either. I've only kept that because I'm a little bit more convinced than I was maybe 2 years ago that whether I want to believe it or not, it will remain some sort of store of value. If enough people value it, it has value.
Right.
The institutionalization of it, I think, helps make that argument. But at that, even holding Bitcoin feels gross to me right now, and I kind of want to sell that as well. But I tried to consolidate my portfolio a little bit more as we're at these high valuations, and there's really nothing in there that I really want to get rid of. So I feel like this might be the steady state for my portfolio for the next year plus.
I had a couple things that, these are things I did today, so I'm not going to talk about it today. I'll talk about it Wednesday when we record, or I'll talk about when we record for our episode that comes out next Wednesday. And I'll talk about it on Discord early next week for anybody that's a member of the starter position. So see, $5 a month gets you some things a little bit sooner, people. I'm just saying. But no, I had a little bit of borrowed conviction that hasn't gone well. And it's some stocks that I won't follow. Like, I will not go read the 10K. I'm not interested in them. And they haven't done particularly well.
Is that because the words are too big in the 10K?
No, they're really small, but they have a lot of letters. So
they do use small fonts in 10Ks. That is a good point.
They do. No, it's just that a couple businesses that I just find myself completely uncompelled to study. And because I don't have any built-in conviction to put in the work, I've just acknowledged that the best thing for me to do is move on. There's plenty of other opportunities. So I've moved on. So these are combined 0.5 percentage point of my portfolio. So it's money, but not, life-changing amount. So do little things like that I've been doing around the edges. And there's one stock that I bought in my wife's Roth, bought like a 2% position, which is pretty big for the first buy in a company, but had pretty good conviction in it. And it's been less than a year and it got up to like 7%. It's done really, really well. But I think the stock has gotten way ahead of where the business is. And that particular portfolio in that Roth is pretty concentrated. So I made the decision it was time to turn some of that back into money.
All right. So there's two questions that are related. And actually, it's something I've been thinking about lately. So Tejo asked you about realty income. Colin brought up
Tejo. It's not Tejo.
Did I say Tejo?
You did.
Oh, I'm sorry, Tejo. I didn't mean to say that. But he asked about realty income, and Colin brought up EPR properties. So I own EPR. Yeah. I used to own, and I've thought several times about rebuying realty income, because part of me, as much as I'm trying to concentrate my portfolio, I also have this part of me that wants to build out a dividend paying portfolio.
Right.
I don't have that many dividend stocks, and being 45, I feel like maybe I should have a little bit more, just kind of to slowly prepare for later on. So let's talk about those real quick. What are your thoughts on realty and or EPR properties?
Yeah. So realty income, ticker O. I own a pretty reasonable amount of it. I think it's a good business. It's a fine business. It's gigantic.
Pretty resilient to recessions too.
Oh, very, very
just
much
what they have there, what they own, right? A lot of convenience stores and grocery stores and things that are not going to suffer when
there's
times are tough.
standalone properties with big tenants, big corporate tenants, big box
dollar stores.
Yeah, dollar stores, that kind of stuff. So, but they've moved into other stuff too. Like they own the Bellagio, the real estate part, the Bellagio. They own multiples of those. They've started being a finance partner with REITs that do other things like digital realty. Hasn't been in a great capital position. Realty income's in a wonderful capital position. So they've joint ventured with digital realty and data centers. So they've done some things like that around the edges that I think are compelling. I think it's fine. I think it's like, for me, it's like a better than a bond investment.
Mm-hmm.
And if interest rates come down, I think that's good, because that's going to create more interest in buying a REIT like this, push the stock price up. So you could get some expansion of the multiples. EPR, man, it's been kind of a rocket ship, using like the dividend yield. It was beginning of the year, it was 7.5%, almost 8%. It's like 5.7%. It's like the yield's pretty close to realty incomes now.
Yeah.
And you and I've been talking for a long time, like on a risk adjusted basis. This has been one of the most compelling REITs to me for a long time. So
my only concern though is, if I'm going to sit here and say, I think we're going to see an economic downturn in the second half of the year, they could stand to be
EPR stock's going to get hammered. The business is going to be fine, but the stock's going to the stock's going to get hit.
Which is, not a reason not to buy it in my mind. I think in the long term, it's fine. I mean, people are going to, when they can, people are going to go do things, right?
Exactly.
That's a quick thesis I have for that company. There was something else in the chat I wanted to grab, and now I can't find it. Oh, LDP. On another topic, what are your thoughts on the huge rise in leverage use by retail investors? So related to that, one of the topics we had on our outline that we didn't get to, and we won't because there's only 2.5 minutes left. I've been saying kind of jokingly, like, just feels like we need a downturn, right? Things are getting a little goofy out there, right?
I was teasing Lewis Brooks about that on the Discord. It's like, stop wanting people to get hurt, Lewis. Come on.
No, but like there's so much speculation.
Yeah.
There's so much fraud out there right now that it just feels like a good long downturn would flush a lot of that out of the system. And, there's a cleansing aspect of it that I feel like we could benefit from.
Right.
And
that's true.
Retail investors using too much leverage, people doing all sorts of crazy stuff. I'll say this, sort of just sum up my thoughts. So I'm almost done with Alex Morris's Buffett and Munger Unscripted book, which is really, really, really good. It's a compilation of things that things that Buffett and Munger have said at annual meetings over the past 30 years. And one of the themes that comes back constantly is just basically the idea that if it's risky, if it's leverage, if it's not conservative and safe, it will eventually blow up. And so we stay away from it. Like that, I'm paraphrasing probably poorly, and it just keeps coming back in my brain because, you read these and it's like, oh, this was 1999 or 98 or 95, right? Like think about what the next 5, 6, 7 years look like. Or this was 2006 or 2007. Think about what the next decade look like.
You look at that cash position that keeps growing, right?
Yeah. So, and it's hard to, it feels like, I mean, I've been paying close attention to this stuff for 5 years, and that feels like a long time, but it's not. This could all just be one big bubble that we spend 10 years getting out of a blow up over, right?
Play out. They take a while to play out. No, that's true. I don't think it's a bubble, but I do think that, no,
I'm just saying you could look back at this 5-year span as like one thing.
I think that's fair.
And you look back at it 20 years from now.
Fair. Lewis Brooks commenting here on YouTube. There went my $5. So Lewis, I hope I haven't been poking at you too much today. You're one of my favorite people over in the Discord, along with everybody else too, of course. But
yes, everyone listening right now is our favorite.
You're my favorite, Lewis. Now, somebody mentioned just real quick hedging. Somebody mentioned hedging. I've bought some puts, S&P 500 puts, as kind of a hedge. If the market does go down, they'll go up in value, right? So I've done a few things like that, but largely I'm not really changing much. A little bit around the margins.
Yeah, I'm not either. Even though I think we're looking at a downturn later, but we'll see.
Yeah. There's how you feel, and there's what you do.
Yeah.
Frameworks, tools, all that stuff. It's 5:00, Jeff.
It is. We did it.
Hey, everybody. Thank you so much. It's awesome seeing so many of you on here. We might have had a record for the number of people that watched it live. For those of you that didn't, every Friday, that's the first Friday of the month, except for the ones that it's not, from 4 to 5 p.m. Eastern, we will do First Friday. So hopefully we can get more of you to check it out. So hopefully we'll see you then. Jeff, we're done here, right? That's it?
We're done. That's it.
All right, everybody. As always, just remember, we love giving our answers to your questions, but our answers are not your answers. You can find the right answers for your financial journey. I believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time. Thanks, everyone.